Welcome everyone back to Pete's Investing Updates. We review the weekly progress of some key share market world indices and gold. These are updated every weekend. And this week's summary, we review our strategy on trading the 15-minute price chart and adoption of the commodity channel index, which we've been following and tracking. As always, if you want me to review an index or a commodity, put it in the comments and I'll cover it in a future video. Don't forget to click on the subscribe button, the notification bell, and like this video to support the channel. As always, refer to the playlists, and this is where we review the indices and post those each week. We also review some blue chip shares, and they're posted there on a weekly basis. But also, we just don't forget to, importantly, to look at the strategy playlist. That's where we post a simple trading strategy, the average down process, and some money management ideas just for your information. As always, we're not offering financial advice. This is purely an educational video series just to further your knowledge about trading and how to invest safely. First, let's go to the indices we're looking at. And you can see here, we're looking at a rolling 5-month price chart on a 15-minute charting horizon, or 5-month horizon, 15-minute price chart. We're looking at these indices, so the US, the Australian market, Germany, FTSE, China, and gold. These are the margins required per contract. So we're trading 5 contracts in each of our trades in this theoretical portfolio. But for each contract, you need $371 for the ASX 200, $220 for the US market, and so on. You'll notice the China market has got a very expensive margin requirement, and gold has got the cheapest one of the list here. Because of that, China, if it goes well, it's going to go really well in terms of profitability, but if it goes south, it's going to go badly, as you can see here. But overall, we're still doing quite nicely, and we're up in our profits, solely based on the other markets doing it according to this. The drawdown is the highest profitability for the specific time period down to the lowest level, and I'll go through what that means in practical terms. And this just calculates out over a monthly period how much profitability we can expect to make, which is simply that divided by the 5 months. And just another thing to notice is these margin requirements, that'll be dependent on your broker and what they charge for each of those contracts when you're into the market. So let's first look at the Aussie 200. We made $371 for the 5-month, we made $3,600 for the 5-month period with a drawdown of $1,600. So what it means and what it looks like in practical terms, it shows $3,600 since we started with our baseline of 100,000 back here. We've made $3,600. Now the drawdown is basically from the highest point of profitability down to the lowest low. So that seems to be the highest to the lowest there. So just to prove the drawdown, how that works, this is just eyeballing. Let's use the ruler, just eyeballing it. Go from there down to there. That's 1468 just by drawing it roughly there, and 1468 compares very closely to the 1600 there. But that's the actual number in terms of the drawdown requirement. And just for those that have got this software package, if we do a detailed report, 1606 is the maximum drawdown. Okay, so that just explains that technicality. The other thing to notice here is this is a price chart, obviously, and these are this little stepping graph. This shows how many contracts we've entered, and where it's doubled up, we've entered another 5 contracts. So each of these, we're trading 5 contracts per trade. So we enter the contracts, we enter the trade here. You can see there's a little break. That's where it closed, that particular opening. We entered another 5 contracts there, it closed it, and then we entered another 5 contracts, that kept it, and it closed it there. It's hard to see up on that point there, but if we drill into it, you can see there the gaps are becoming more prominent. So that there, you can see there again is another sale there. We entered another one there. Then the market started, that was when it was going sideways. The market started going down south, and that's where we entered our second 5 contracts for that particular trade. So we ended up having there, if you leave the cursor there, you'll see their positions 10. And it finally closed out with a profit. And that profit up there, that close. You see it from 100,000 baseline, so 22.97 was a closing profit, and when it opened up about there, it's 15.90. So 22.97 from 15.90, that's about $700 worth of profit gained in that trade from there to there. It's a single trade with one set of 5 contracts entered there and closed there, and so on. Now, part of our strategy is in terms of entering the market. Let's just go back to our previous week's trade. So we're now August the 8th. The week opened up back here on Monday. Opened up there at that point there. It rose quite sharply, then it went sideways for a while, then it started going a bit north there, which is good, and it opened up 5 contracts there. So our strategy basically relies on a couple of things. You can see, let's look at this trade here. Actually, look at this smaller trade over here. So it opened up 5 contracts here, and it closed it out there. Now, what it looks at, this is the CCI 100. And what we've done is we put a moving average 20 along that CCI of 100. So we follow the moving average 20. And when that moving average 20 breaks above the 0 line, which is there, we enter the contracts. We enter 5 contracts. So the price went up a bit, went down, went up again, and it started appreciating. And then it finally closed the 5 contracts there. Now, there's 2 criteria that's the first criteria is to enter that market when it breaks above 0. The criteria to close the market is when it breaks below 0. But also, we need to make at least a profit of at least the average of, you can see each of these are 15-minute bars. What we do is we measure from that point there, we measure back 100 bars and say, okay, what is the high-low range of those 100 bars? So that's our minimum profit requirement. So we need to gain that profit before we can actually close the market when that CCI 100 moving average 20 breaks below 0. So in other words, what we're looking at here, for example, if we did, for example, let's draw a line. If we drew a line, say, from there to there, this is very rough. I've got a calculation which does this a lot neater. Let's say we did it from there to there. That is roughly, let's just draw this line. So we're saying from there to there, it's about 13 points in terms of gain. So what we're saying is it must, once it breaks above our break-even point, so if our break-even was at that point there, 73, if you look over here, where that entry was made, around 73.05, 73.10, say for example, we want to go at least 13 points above that. So our break-even would be around, say, 73.25. So if it went above there and the CCI breaks below the 0, that's where we close it. Now, it broke above there, but notice the CCI was still above 0. So had it been that high and it broke below 0 there, that would have closed there. But because it fell below, the price fell down there, but the CCI was still above 0, it didn't close. At this point, the price kept going that way, and up until here, the CCI is still above 0, so we want to let it go if it's still above 0. Price kept going up, and then it finally broke below 0 there. That's how it works. So again, this week was a nice week, nice little range. It went up, and we made a nice little, hasn't closed out the profit the trade yet, but it's looking positive for the coming days coming up. Next, we'll look at the US market. Let's look at the week first. So it opened up back here on Monday, and very similar to the Aussie market, and it went sideways for most of the week, then it appreciated at the end of the week. But this position now has been open for a few more days, longer than the Australian market. You can see there, the profitability is at 28.43 from an opening profitability for this trade at 27.06. So it's made about 140 odd, 120 odd dollars so far, but hasn't closed out yet. Bigger picture, you can see they're opening up back here. It's done quite nicely. They're all been single 5 contract trades, no averaging down on this particular index for the US market. So it's made 28.43 for the US market, and that's reflected by that. Next, we look at Germany. Look at the big picture first. That's a lot more volatile, a bit of a roller coaster ride. All single 5 contract trades except for this one here. It opened up there, fell off into another contract down the bottom there, according to our CCI entry criteria, and it's fallen. The other thing too is with the entry of an average down, it needs to fall 2 times the high-low range. So what I showed you before about the high-low range, it was 13 in that example. In this example, let's say it's 20. It needs to fall at least 40 points or 2 times the average high-low range. And then the CCI needs to break above the 0 for another entry to apply. In other words, we don't want to enter too many times up here somewhere. You don't want to accumulate too many contracts because that'll just put you more in the red if it goes against you. In this case, our profitability fell from there down to there. Had you had more contracts open here, that profitability would have been a lot lower. So you want to separate the drawdown as much as possible with a reasonable gap. So it into the second 5 contracts here. So now I've got a total of 10 contracts there, 10 positions. That finally closed out there. Obviously, when you average down, your break-even point lowers along with that. So it's no longer up there. It's probably down there somewhere. That's why it's closed out about there. FTSE, UK market. Okay, this is a longer 5-month view. Similar to the German market, very volatile and very roller coastery. As you can see here, has appreciated quite nicely for the week. And that's looking like it's closed out that trade late this week. You can see there it opened there, went up and it closed out with some small profit there. So it closed out the profit there at 46.57. Our profitability back there was 45. So it made about $100 on that little trade. So it's very flat, but it still made a profit. Last index we look at in terms of world index is the China market. Let's look at the week's progress so far. This has been very flat, consolidating sideways. Hasn't done much for the week. But let's look at the long-term view. This has been a bit of a headache in terms of profitability for us. It's went sideways most of the first couple of months since about March through to about there, around June. It's gone sideways with a couple of average downs happening there. And our major averaging down happening now here. It opened up our initial contracts, 5 contracts there, entered an additional 5 contracts there, another 5 contracts there, another 5 contracts there. So you can see what it does. When you enter more contracts, it actually pulls more of a drawdown on your account value. So again, you want to try and minimize or maximize or optimize, I should say, optimize the distance between your last entry to your next entry. You don't want to bring these entries anywhere closer or higher up because you'll just pull up more of your drawdown. Lastly, let's look at gold. So again, this had a big rise during April, May, then it fell off in June. It's been going sideways and had another drop off again this last few days. You can see there the initial entry was made there. Another entry was made there, and it's been going sideways since. Now, again, because we've got a very low margin requirement for gold, our profitability on this one is very low as well. So you can see that correlation. The bigger the margin requirement, generally the bigger the profit, but also the bigger the loss if it occurs. Now, I've been using 5 contracts across the board just to make the charting easier to read and easier to manage. But you'd have to obviously, if you want to use, for example, 5 contracts for the ASX, 5 contracts for the US market, you may want to use 1 contract for Germany, maybe 2 contracts or 3 contracts for FTSE. You'll definitely use 1 contract for the China market, and you may want to use like 10 contracts or even 5 contracts for the gold market. So you want to, depending on your account balance and your risk appetite, you want to try and optimize your exposure to the drawdown potential. But anyway, that's your 5-month revenue, and that's your monthly revenue. It's basically that divided by 5. So as always, don't forget to subscribe, click on the notification bell, and like the video to support the channel, and speak to you guys next week.